Morning, Bill here with another edition of Metal Minutes. Today is Wednesday, May 19th, 2021. Well, we've seen a pretty good rise in gold and silver again this past week. We've got gold up 2% to 1876 as of the time of this video. We've got silver up 2% to 2787. We have platinum down 4% to $1,200, and we've got palladium down another 2% to $29.05. Now, for the 1 year, we have gold up 7%, silver's up 60%, platinum is up 43%, and palladium is up 43%. Now, sometimes people wonder, how could silver be up 77% the week prior for 1 year, and this week for 1 year it's only up 60%? Well, that's because silver had a pretty good run a year ago, between a year and a week ago and a year ago. So it's a function of not only what's silver doing now, but where was silver back then. So that's how they can move that much sometimes in the 1 year numbers over a 1 week span. But let's talk about platinum and palladium versus gold and silver, because there's a new dynamic that seems to be taking hold. Now, we've been talking about palladium, that it was a good time to take some profits, so that's shouldn't be a surprise that it's down again for the week to another 2%. It's still fairly close to its all-time high, and I still feel like if you're going to take profit from somewhere, that would be the place to do it. Platinum is still, I believe, a fairly good place to be. However, there's a difference. There's a chasm building between gold and silver versus platinum and palladium right now, and that has to do with investment demand. Investment demand for gold and silver is off the charts, and that's something that platinum and palladium, as more industrial metals, don't quite have the same, they don't get the same attention from the investment community. So that's one of the things that we see happening. And in our article that's referring to Basel III, I've got a link in this short article. It mentions the fact that silver has had more investment demand than industrial demand, which is one of the first times that's ever happened. So we're in a season where people are clamoring for silver and gold as an investment. And so that's a new avenue that platinum and palladium don't have to the same degree. Now let's highlight the difference between ETFs and physical, because people in the investment community say, oh, don't buy physical metal because it's a hassle. You know, it's a hassle to store it, it's dangerous or whatever. But there are good vaulting decisions that you can make, such as at the Texas Bullion Depository, affiliated with the United States Gold Bureau. It's not managed by the federal government. It's not managed by a commercial bank. It's truly a safe place to store your metals that's free from a lot of the concerns that people in the gold and silver community have. And the cost is very reasonable. And the reason I bring that up is because people that are trading these ETFs because they're easy to do, they may be easy, but you're leaving a lot of the gains on the table, because there's such demand for physical metal right now that the owners of the silver and gold ETFs are not participating in terms of the gains. As an example, and I go into this in more detail in the main article this week, but as an example, if we look at the spot price of gold and silver from the time we began looking at Basel III and that regulation change that's bringing gold and silver higher, gold is up 45%, actually more now, but when we wrote that article, it was up 45%. Silver was up, I think it was 89% or 86, one or the other. But that was for the spot price. The spot price is becoming even more irrelevant as we get closer to the implementation of the Basel III rules. And so the difference in the physical price, I use a Silver Eagle as an example. The difference in the silver price is 164%, I believe. It's 164, 169. But versus 86 or 89 versus 164. That's quite a difference. And the only people seeing that additional gain are the holders of the physical metal. And we could talk about horror stories. I've written about this before, those of you that have been readers for a while on the blog. But there was a day when, not too long ago, just last year I believe it was, I know people that were invested in oil ETFs. And you may remember the time that oil got to a negative price. It was like negative $38 a barrel or some such nonsense because of how things were trading on the market. And I have friends that jumped into some of the oil ETFs when the price got so low, and they felt like, oh, it's a no-brainer. Oil's going to come back and we're going to reap the profit. Well, they invested in some oil ETFs that with all the stuff going on, they imploded. And so they ended up with pennies on the dollar for their investment. And they had no physical oil. Of course, they didn't want to have physical oil. That's hard to store. The same thing or similar things can happen with these ETFs attached to metal, but for the opposite reason. Not because the metals are going down so much, but because they're going up so much. So it's the same principle in reverse. So I want to encourage you to really consider getting physical metal. It's fine to have the paper investments for, if that's the only option you have, but it's worth the effort to have the physical metal because almost twice the gain right now because of the amazing physical demand that we see. So thanks a lot. Keep an eye on these things. It's getting exciting. Silver squeeze movement is in high gear, and Lord willing, we'll see you next week. Thanks a lot.